Assalamu alaikum friends, welcome to today's lecture. So today's standard is IAS 32, which is on financial instruments presentation. Okay, so this is one of the, as you know, that financial instruments is one of the toughest area in SBR. So I thought that before I cover any other standard, let me finish this standard so that you will have more time to go through this standard before your exam because it requires more revision. And it is one of the biggest lecture also, so this there will be so many parts to this. Okay, I cannot cover everything in one video, but I will definitely break down the information and then I will make different parts to it. So starting on that note, as you can see, let us go through this. What are we going to cover here? Okay, this financial instruments is divided into three standards: IFRS 9, IFRS 7 and IAS 32. Okay, I already have made a video on IFRS 7, that is for disclosure of financial instruments. Please go check it out. It's a small standard, but it is when you're using it, don't treat it as an isolated standard. It is with this, okay, in conjunction. It is interrelated with the standard IAS 32 and IFRS 9. So today's standard will be on IAS 32. Right, before I touch the main standard, which is IFRS 9, let me finish the classification part of it, which is presentation part of it, which is IAS 32. Okay, so first we are going to introduce financial instruments, then we are going to classify the financial instruments. There are various types of financial instruments. It needs to be classified into their respective category. Third, we are moving on to the recognition and the measurement of financial instruments. Okay. Then we have the impairment of financial assets. Like any other assets, financial assets are also subject to impairment. Okay. Then we have derivatives. Okay. So then we have hedge accounting. Then we have the disclosure of financial instruments. How do you disclose the financial instruments? I have covered that in IFRS 7. So I'm not going to cover it again. Okay, hedge accounting and derivatives are not like what you have learned in financial management or your advanced financial management, like options, swaps and all. No. We are not going to study those in detail. We are just going to study how to account for that. How are we going to uh, measure and recognize it? Okay. So let us introduce. And some of this you must have already gone through financial reporting, FR paper, but the situations in SBR will be more difficult. Okay, because you are going to study more complex issues. What are those? Such as impairment and hedging accounting. Remember, impairment and hedge accounting is little bit difficult, right? Difficult in sense of it's not impossible, but it takes time to understand at first. You will not understand at first instance, maybe most of you, but some of you might. Okay, so that's why I will keep my lectures very simple. Like it will be very simple so that anyone can understand it. Okay, first we are going to start. First, we are going to start with the definition because it's very important that you know the definition of each financial instrument. Okay, in this standard, what you have to know is the definition. What is a financial instrument? Definitely, you will not be asked, okay, what is financial instrument? What is financial asset? You will not be asked like this in the exam. But in order to understand how an item needs to be recognized or measured or presented in the financial instruments, the definition you should know. Definition is like a supporting thing. It supports your answer. So for that, you need to know the definitions. Okay. So the first definition is of the financial asset. Okay. This comes under IAS 32. Okay. Because in the bracket you can see it is IAS 32 is given. IAS 32 para 11. So a financial instrument is any contract that gives rise to financial asset of one entity and a financial liability or an equity instrument of another entity. What is it? What does it mean? In one party will have the financial asset, the other entity will have the financial liability, because what is asset for you might be a liability for someone else, right? What is liability for you might be an asset for someone else. You're understanding the normal sense. So in that way, financial asset and liability also. What is financial asset for you might be a financial liability for another thing. So it should give rise to two things: financial asset for one entity and financial liability for another entity. For another entity, it could be financial liability also or equity instrument also. Okay, it could be either equity or either financial liability of another entity. Okay, so this is something which is easy. The definition is not very difficult. What is financial asset now? So we are now going to break down each. What is financial asset? What is financial liability? What is equity instrument? Only three things you have to know in the whole IFRS 9 financial instruments is three things only you need to remember: financial asset, financial liability, equity instrument, and the recognition, measurement, derecognition, presentation, disclosure of each of these three items. That is all the thing you need to know. That's why this lecture is very big. Okay, so starting with financial asset. Okay, financial asset is an asset only. You take it as an asset. Okay, it is any asset that is cash, because finance, right? Financial asset, so cash will be involved. An equity instrument of another entity. Okay, because we have told here what is a financial instrument. Any contract that gives rise to a financial asset of one entity, or it could be a financial liability also, or equity component of another entity. That's why an equity instrument of another entity is your financial asset. Understanding? So that is an financial asset. Third, contractual right to receive cash or another financial asset from another entity. If you have the right to receive cash, for example, your debtor is your financial asset because you have the contractual right to receive cash, isn't it? Whether they pay you on time or whether they don't pay, whether they become a bad debt is another thing, but you have the contractual right is there with you. Okay, or another financial asset from another entity, or you have the contractual right to receive another financial asset also from another entity. Might not be always cash, right? It could be cash or financial asset from another entity. You have the contractual right. The word here is contractual right. Okay, you have this contractual right to receive either cash or financial asset. Then it's a financial asset. Then a contractual right. Look at the meaning everywhere. If you see, this word is always there when it comes to financial asset. Contractual right, contractual right, contractual right. Okay, again a contractual right to exchange financial instruments with another entity under conditions that are potentially favorable to the entity. So the keywords which you need to know here is contractual right to exchange financial asset with another entity under conditions that are potentially favorable to the entity. Favorable and contractual right to exchange financial instruments. Okay, you can exchange financial instruments, but only when it is favorable to the entity. Only when you think it is advantageous to you, you exchange financial instruments. Okay, for example, we have taken an instrument. Let's say we have taken a convertible debt. Okay, convertible instrument, let's say. Convertible means later you can convert the debt into equity. So you will only take that instrument if you think that converting the debt to equity. That means what are you doing? You are exchanging the financial instruments. Now before it was debt, now you are converting into equity. So for debt to equity, you will only convert, or you will only go for that financial instruments only when you think it's favorable for you to do so. If you think it's favorable to turn it into equity, the debt to equity, then only you will take that. Okay, there's a contractual right to do that only when it is advantageous, favorable. So remember the word favorable when it comes to financial asset and contractual right to exchange financial instruments. Okay, next, a non-derivative contract for which entity is or may be obliged to receive a variable number of the entity's own equity instruments. This is very important because from the exams point of view, this comes a lot of time. Many students are not able to understand this point. A non-derivative contract for which the entity is or may be obliged to receive a variable number of the entity's own equity instruments. The word is own equity instruments. It's a non-derivative contract, okay? And they can receive variable number. Variable number means it's not fixed. The number will change. For example, let's say dividend and interest, okay? Dividend, we know dividend is variable. It might change. Sometimes you might not receive depending on the performance of the company. For the equity shareholders, they might receive dividend, they might not receive dividend. It's variable. But when it comes to interest, when you take a loan on interest, interest is always fixed. You have to pay that interest to your debt holders, right? It's fixed. So that interest is not financial, it's not financial asset. We know that because it's fixed. It is a financial liability. Okay. So that's why the moment when you see these words, okay, non-derivative, then variable, then entity's own equity instruments, it is what? Financial asset. Okay. Maybe I will write only the keywords. Non-derivative contract, number one. Number two is variable. And number three is own equity instruments. Entities own equity instruments, okay? This means it's a financial asset. Contract should be non-derivative, okay? They may be, the entity is or may be, okay? The entity could be obliged or may be obliged to receive a variable number. So the word variable will be there, and entities own equity instruments, okay? So all these five are examples of financial asset. Now let us go to the next item, next financial instrument. All these are examples of financial instrument. There are three financial instruments: financial asset, financial liability, equity instruments, okay? Now let us go to the financial liability. Okay, what is liability? There are only three examples given to liability. What is it? Now the word changed. Now it changed to contractual obligation. So in financial liability, what you have to remember is contractual obligation. Okay, if it is financial asset, it is contractual right. If it is financial liability, it is contractual obligation. Okay, to deliver cash or another financial asset to another entity, same cash or financial asset only, but here you are delivering, you are not receiving. Okay, let me take you to, let's just check the first point. Here it is contractual right to receive cash or financial asset. Here also it is same, the sentence is same, the wording changed. You see, here it is contractual right, here it is a contractual obligation. Here it is receive cash because financial asset, here you have to deliver cash, you have to pay the cash or financial asset to another entity when it comes to liability. Okay, next point says contractual obligation to exchange financial instruments with another entity under conditions that are potentially unfavorable. That's why I told you to underline the word favorable here. Okay, here same sentence as this one, the fourth point. The only change is unfavorable. Then what do you exchange? Okay, just know that financial liability is just a opposite of financial asset. Contractual right becomes contractual obligation. When you have to receive cash, it becomes payment of cash. When it's favorable under assets, it becomes unfavorable under liability. That's it. This makes your work so much easier to memorize, also to remember also. You remember one thing properly, the other thing is just the opposite of it. Okay, so this is unfavorable. Okay, remember financial liability unfavorable, then you exchange. The sentence didn't change, sentence are same as it is, only the wording changed. Here also, example like the last point, it's a non-derivative contract for which the entities or may be obliged to deliver a here they are delivering. Still it's a non-derivative contract, like for financial asset, that will not change. Okay, so the moment they say derivative contract, you know it's not financial asset, it's not financial liability also. Okay, because it should be non-derivative. Here they are going to deliver again variable number of entities own equity instruments, variable number of entities own equity instruments. Okay, so the only word is deliver that is changed, everything else remains the same. Now let us go to the equity instrument. Equity instrument is just one. Okay, so equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. What is equity? What is the definition of equity? Formula of equity: assets minus liabilities, right? The same here also. It's like a residual interest. This is the word you should know. That means the balance is equity after you deduct your liabilities from assets. Okay, so equity is very pretty much easy to remember. It's nothing so difficult. It's like assets minus liabilities only. Okay, that is equity in instruments. Now let us go to the reporting standards. And another thing I want to note here, I want to tell you is that, see, you don't have to think about what if I forget the three standards. Because some might think that it's all under one standard, IFRS 7, IFRS 9, IAS 32, right? They think it as one standard. Okay. As far as you remember the correct definition of financial asset, liability, and equity, you are right. You can just state the definitions. Okay. It does not matter which standard you are using out of this three. Okay. If you forgot that standard, for example, some might write the definition and they will write IFRS 9, or some might write IFRS 7, or some might correctly say it is IAS 32. So you might forget the number, it's okay. If you forgot the number, don't write the number, but just know that you know the correct definition of financial asset and liability. That's it. Okay, that is the important thing. Now coming to the reporting standards. There are three standards that deals with financial instruments, because financial instruments, as I told you in IFRS 7 also, it is an area which is so complex, it can easily be manipulated, you can easily hide fraud, okay, inside the financial instruments, because you know that no one will understand it, right? The users will not understand financial instruments so much if it is not disclosed or presented properly. Okay, that's the reason why so many business collapsed. One of the reason is financial instruments only. They are carrying huge financial instruments. Remember always one thing, that whenever something is easy, it is easy for others to understand if there is a mistake in that or not. It's easy for others to catch because it's easy to understand. Everyone can understand it. Okay. But if something is very complex in nature, no one will break their head to find out the mistake over there. They will not understand it. Not everyone will understand it. So it's easy for you to do fraud or manipulate the accounts in that area which is more complex. Same for financial instruments. It's basic knowledge, right? Common sense only. Financial instruments. That's why there are three separate standards, right? If you see any other, there are no in SBR. If you see the other standards, nowhere there are other standards more than one. Okay, for each item there is only one standard. For non-current assets, we just have one. For revenue, we just have one. But only for financial instruments, we have three standards. Okay? Because it is so important. The reason is that people cannot commit any fraud. Okay, to prevent that. That's why they are making it more strict. That's why there are three separate standards. IAS 32, presentation. Presentation means how do you present your financial asset, financial liability, and equity. Okay? IFRS 7 disclosure, I have explained. I have the video on the disclosure. You can go check it out. Where how do you disclose? Okay. IFRS 9 is the main one, which is financial instruments, which deals with your recognition, derecognition, measurement, hedge accounting, and everything. Okay. The balance is dealt with financial instruments. Okay. So IAS 32 and IFRS 7 are small standards. You can quickly cover them before you attempt IFRS 9. Okay, when you're studying, I would say that finish IAS 32 and IFRS 7 before you attempt IFRS 9. Because they're small standards, you can easily cover it in one day. Okay, in one day you can cover both IAS 32 and IFRS 7. It's possible, but IFRS 9 takes time. Okay. Now let us go to IAS 32. So it deals with the classification of the financial instruments and their financial statement presentation. How do you present in the financial statements? IFRS 7 is disclose. What is how much you disclose and what items do you disclose about financial instruments in the financial statements? IFRS 7, initial and subsequent measurement. Okay, how do you initially and subsequently measure the financial instruments? Now, whenever I say the financial instruments, it includes all the three: financial asset, financial liability, and equity instruments. Okay. Now let us go to the main thing: classification of financial liabilities and equity. Okay, you need to classify. Okay, you need to classify whether it's a financial liability or an equity instrument. Okay, for that, to understand that, we have already went through the definition earlier. Now let us do this test your understanding to see how well you have understood liabilities or equity. Okay, because for equity they just told residual interest, it's just the balance of asset minus liability. They didn't give any definition. Now you have to say this. Okay, discuss whether this financial instrument should be classified as financial liabilities or equity. Okay, this is a very good question for you to start with when you're attempting IFRS 9 also. Okay, because in the exam also Lot of times I've seen this question that you have to define whether it falls in financial liability or falls as an equity. It's very important that you know it. Okay. So Costa wishes to purchase a new ride for his Animation Galaxy theme park but requires extra funding. Costa issues the following preference share. Let us see. So this three we are doing separately. 1 million preference share for 3 each. No dividends are payable. Costas will redeem the preference share in 3 years' time by issuing ordinary shares worth 3 million. Exact number of ordinary shares issued will be based on their fair value on 30th September 2006. Next, 2 million preference share for 2.8. No dividends are payable. The preference share will be redeemed in 2 years' time by issuing 3 million ordinary shares. Next, 4 million preference share for 2.5 which they are not mandatorily redeemable. A dividend is payable if and only if the dividends are paid and ordinary shares. Okay. So we have to go through this, right? Just to understand it. I think it's at the end you will have. So let us go. Yeah, all this are there. You can see all this are in the IFRS 9. Okay, you can go through this and have an idea. I'm going a bit fast because anyway we'll cover all this in IFRS 9. Here. So the first one, the definition of financial liability includes any contract that may be settled in a variable number of entities' own equity instruments. Therefore, contract that requires the entity to deliver as many of the entities' own equity instruments as are equal in value to a certain amount should be treated as a debt. Okay. Deliver as many of the entity's own equity instruments as are equal in value to a certain amount should be treated as a debt. Costas must redeem the first set of preference share by issuing ordinary shares equal to value of 3 million. Right? The 3 million received from the preference share issue should be classified as a liability on the statement of financial position. Because they are redeeming the first set of preference share by issuing ordinary shares equal to the value of 3 million. So the 3 million received from the preference share should be classified as a liability. But because look at the definition. Includes any contract that may be settled in a variable number of the entity's own equity instruments. Okay. So the contract that requires the entity to deliver as many of the entity's own equity instruments equal to the certain number. If it is equal to the certain number, should be treated as a debt. Okay, so it is equal to the value of 3 million, therefore it's debt, liability. Next, a contract that will be settled by entity delivering a fixed number of its own equity instruments is an equity instrument. Remember the word fixed. If it's fixed, it is equity because we told variable is equity, right? Sorry, variable is liability, so fixed is equity instrument. So Costas will redeem the second preference with a fixed number of ordinary share. Therefore, the 5.6 million for the second preference share should be classified as an equity. If it's fixed number, it's equity. If it's variable, it is liability. The 4 million shares. A financial liability exists if there's a contractual obligation to deliver cash on other financial assets. There is no obligation for Costa to repay the instrument, is it? If there is no obligation, it means what? It's an equity. But dividends are only payable if they are also paid on ordinary shares. They told about dividends, right? They told that dividend will be payable if they are only paid on ordinary shares. Also paid. So we know there is no obligation, right? Are there any obligations for you to pay dividends? No, right? So there's no obligation to pay dividends on ordinary share. So there is no obligation to pay dividends on this preference share either. So the instrument is not a financial liability. Okay. The process from the preference share issue should therefore be classified as equity because there's no obligation to pay dividend. So it's an equity. Right? So now let us go back. Okay, we went to the previous chapter. So now we are done with it. Okay. Know that the board have issued discussion paper on the topic of financial liabilities and equity, right? They have issued a discussion paper, and this you have to learn. Okay, there's a discussion paper on the topic of financial liabilities and equity, and this is an examinable current issue and is covered. Okay, it is examinable current issue. You are going to be asked from this discussion paper based on it is there later in chapter 23, because discussion paper will cover all the discussion paper, but at the end, after I finish all the standards, I'll be covering discussion paper and all the current issues and all. Okay. So interest, dividends, losses and gains. Okay. The accounting treatment relating to the financial instrument following the treatment of the instrument itself. You have to understand how do you treat the instrument itself. So based on how do you treat the instrument itself. Okay. These items relating to those financial instruments also will be treated equally. You understanding? The accounting treatment of interest, dividend, losses, gains relating to your financial instruments follows the treatment of the instrument itself. That means the way you follow treat the instrument itself. So, so any of this, let's say the losses relating to that financial asset will also be treated the way you have treated that financial asset. Okay. If that financial asset, let's say it is an asset, or let's say a financial this one, an item is treated as a financial liability. Okay, so any item will be treated as a liability relating to it, interest, dividend, losses or gains. Okay, so now let us go through an example to understand this. Okay, this too. Dividends paid in respect of preference shares classified as a liability will be charged as a finance expense through profit and loss. Okay, if the preference shares are classified as a liability. Okay, I'm going very slow. I don't want to rush through and all, so that people will have lots of doubts. So dividends, okay, if you have to see the preference share, how preference shares are classified. If your preference shares, because we know preference shares can be classified as an equity also or as a liability also. Okay, because why? Because preference share is redeemable and redeemable. Okay, redeemable preference shares classified as something else, irredeemable preference shares are classified as something else. Let's not go in depth into that now. Okay, let's look at the word preference shares only. Forget about redeemable and redeemable. So if it is classified as a liability, preference share, any dividends relating to that will be charged as interest. Okay, that's why it is as a finance expense. Finance expense or interest, same thing only, and it will be there in the profit and loss account. We know where does expense go, where does interest goes, profit and loss account, right? Same, because you have treated preference share as liability, so the dividend relating to that preference share also will be interest. It will be treated as an interest, because you pay interest on liability only, right? And it will be charged through profit and loss account. Second, if dividend paid on shares are classified as an equity, where does it go? If it is classified as equity, the shares, then any dividend paid regarding to that equity will be there in the statement of changes in equity. Okay, this will go through profit and loss account as a finance expense if it is liability. If it is equity, statement of changes in equity. It's very easy to remember. See, if you forgot in case, just look at the word equity here. You can see equity, statement of changes in equity. It's easy. Equity is there, right? Here it is liability, profit and loss. So liability, profit and loss, equity, statement of changes in equity. Remember this, it's easy. Next we have offsetting. Again, very important thing. Almost this is asked always, I've seen. Offsetting means financial asset minus financial liability. Can you offset and put it as one amount? Or financial asset or liability needs to be shown separately. That's what offsetting means. So IAS 32 states that financial asset and financial liability may only be offset in very limited circumstances. The net amount may only be reported when the entity has these two things. This two needs to be satisfied. Either one of these two. Then only you can offset financial asset minus financial liability and put an amount. One figure. If these two conditions are not there, you cannot write it. You cannot net it off. You have to show it separately. What are the conditions? Make sure that you know the conditions. because sometimes in the exam they might ask you whether to offset or not. So as a legally enforceable right to set off the amount, they have the legally enforceable right. Okay, so in the exam scenario, they will tell you whether the entity has the legally enforceable right to set off or not. If they have, offset. If they don't have, don't offset. Intends either to settle on a net basis or to realize the asset and settle the liabilities simultaneously. What are you doing? You are intending to settle on a net basis. Number one, or to realize the asset and settle the liabilities simultaneously. Okay. So asset and liability, the transactions are happening together simultaneously. So when it's happening simultaneously, you can net it off. Or also you intend to settle on a net basis. Your intention is to settle it on a net basis. Then also you can offset it. Okay. So remember these two conditions. Now let us go to the investor perspective. Okay. So the classification of financial instrument as either liability or as an equity will have a major impact on the financial statements, thus affecting investors' perception on an entity's financial performance and position. Remember, the way you classify will tell a lot about your performance. You have to be very clear on how do you classify it as a liability or an equity. Okay. This is an area which could be asked in your exam, major area, right? Classification of liability versus equity. If an entity issues an instrument and classify it as a liability, then gearing will arise. Remember, instrument, okay, when you classify it as a liability, simple way, when you increase your debt or when you take a long-term loan, it increases your liability, right? So same concept you have to apply in the financial instrument also. It's nothing difficult. Okay, it classify, if anything increases your liability or you classify anything as a liability, gearing will rise, right? Because debt is there now. How do you calculate gearing? Debt divided by debt plus equity. Your debt will increase. Liability increase means debt will increase. So gearing will rise. Classify as a liability. Gearing will rise. What happens? An entity will appear more risky to potential investors. More risky. That's why you have to be very, very careful. And how do you classify? It's not the matter of, okay, you can classify it anyway. It does not matter whether it's under equity or liability, as far as I'm showing it, right? No, it matters. The way you classify it matters a lot. That's why this is up to standard, no, on IAS 32. Otherwise, everything they could have put it under one standard. So it will be more risky if gearing increases. We know that gearing increases your financial risk. So the servicing of the finance will be charged to profit and loss, reducing profits and earnings per share. What happens? The servicing of the finance, that means what, your interest, right? Interest related to that liability will be charged where? Will be charged in the profit and loss account. So because of that interest, your profits will reduce. And profit reduces mean earnings per share also will reduce. You see the impact? Now let us see when it is taken as an equity. If an entity issues an instrument and classified as an equity, then gearing will fall. Definitely. Because your equity will increase. Okay. We know debt divided by debt plus equity. So it will reduce your gearing. And because for equity we don't charge interest, so nothing will be charged. Okay. But we know that the servicing of the finance will be charged to directly to retained earnings. It will go to the retained earnings, right? Anything relating to equity goes to retained earnings. And so it will not impact profit or earnings per share. So it will not have an impact on the profit or the earnings per share because no interest is charged in the profit and loss account. In order to ensure that the instrument is faithfully represented in the financial statements, directors will need to apply their principles in IAS 32 to the substance of the arrangement. Okay. You have to be sure that financial instruments are faithfully represented in the financial statements. That's why you have to apply IAS 32. Now let us go and from recognition and measurement of financial liability, from here onwards, it is dealt under IFRS 9, but a small portion is there for IAS 32 that I want to cover, which is related to the compound instrument. Okay, so let us skip all this. Okay, this one, compound instrument. Small section is there. We are only covering from here to here. From here to here only will be covered in IAS 32, and that's it. Then we'll be over with IAS 32. Okay, because the rest all below what you can see, initial recognition on all, will be dealt in IFRS 9. What is a compound instrument? This also make sure that you know the definition. Okay, a financial instrument that has the characteristics of both equity and liability. So the moment you say compound, it's easy. Compound means it has two things in it, this and that together in one. That is compound, no? General meaning of definition of compound means that, right? So here it has the characteristics of both equity also and liability also together in one instrument. It is neither fully equity, it is neither fully liability, both it has in one instrument. That is known as compound instrument. An example is also given for you to understand. What is it? A debt that can be redeemed either in cash or fixed number of equity shares. We have convertible debt bonds, right? Convertible bonds and all. That means the debt later we can change it to equity. Fixed number of equity shares. Okay? Either you can change it to cash or fixed number of equity shares. So this is like the biggest example. This you can use throughout to understand compound instruments. Debt that can be redeemed in cash also, or equity shares in a fixed number of equity shares. How do you present this compound instruments? That is the only concern of IAS 32. That's it. Requires for compound financial instruments to be split into two components. You have to split this into two components. You cannot write it as one instrument. Okay? And remember that these two components must be shown separately in the financial statement. Separately it has to be shown. How do you write it? Financial liability. Okay? You show it as financial liability, and the other one is equity instrument. Simple. Whatever is financial liability part, you write it as financial liability. Whatever is equity instrument part, you write it as an equity instrument part. Okay, financial liability. The liability to repay the debt holder in cash. Right? Remember, it's like an obligation. You have to pay the debt holder in cash. That is the liability part. Okay? The liability to repay the debt holder in cash. What is the equity instrument part out of this? The compound instrument, the option to convert into shares. The option you have, right, that you can convert into share, that is the equity instrument part. So that's it for IAS 32. I've successfully completed IAS 32. So I hope that from today onwards, financial instruments will be very easy for you and you will love this chapter. I'm trying to make it interesting and easier for you to understand. And so the next standard, definitely you guys have guessed it right, it is IFRS 9. So best of luck and see you in the next video. Till then, take care.